It is a busy morning for Wall Street. Economists around the world as well. The stock market opened down some 1,300 points this morning. The president says there's nothing to worry about, though many economists don't appear to share that sentiment. But I just took a look at the Dow and all of a sudden I saw green. Up and down, clear uncertainty. So to provide some insight, we've asked economists with Beacon Economics, Dr. Chris Thornberg, to join us this morning. Dr. Thornberg, thank you very much for your time. We appreciate it.
Yeah, it's great to be here.
What kind of short and long-term effects do you think these tariffs could have on both the U.S. economy and also our relationship with trade partners around the world?
Yeah, well, it's obviously not good, right? You're talking about, look to be close to a 20 percentage point increase in tariffs. That's a big number. That's going to make imports more expensive, which means, of course, that, anything we buy from overseas is going to end up getting priced higher here inside the United States. But then, of course, at the same time, we also know that our foreign trade partners are going to be retaliating against us. We know China has slapped some retaliatory tariffs on the United States, and Europe has followed suit as well. And yeah, it's going to make trade relations a lot more frosty and slow down overall economic activity. Now, I think the key here is to ask the question, is this enough to cause a recession? And the answer is by itself, no. But we have to keep something in mind. This is not happening in a vacuum. We're starting a trade war in the midst of a U.S. economy that in many ways is overheated by the foreign flows of capital that have been washing into this nation over the last couple of years. The dollar is very strong. Our current account deficit is very wide. And of course, if we start off a major trade war, what you're going to see is a big decline in the dollar, and that's going to cause a secondary increase in interest rates. So the hit to the U.S. economy is not just going to be in the price of goods, it's also going to be in the price of capital. And I think that's the broader picture that everybody should be worried about.
At what point, as we've been talking with, using interviews with Fed Chair Jerome Powell saying, we're just kind of waiting to see what happens. Where do you think that level is in terms of interest rates, as you talked about, where something needs to then be done?
Well, that's just it. The Federal Reserve is really between a rock and a hard place right now. Look, a lot of the chaos in our economy today happened because of the fundamental mistake they made back in 2020, where they violently over-responded to the pandemic. As tragic as the pandemic was for humanity, it was a depression-causing event, and putting $5 trillion of quantitative easing in the economy was so far overdone. Now, here we are. We have Trump starting a trade war. We have the U.S. economy dependent on foreign flows of capital. And yes, at some level, the Fed wants to cut interest rates because that will obviously help some of the issues having to do with the turbulence caused by the tariffs. But by cutting those interest rates, he's also going to cause the dollar to fall, which makes those foreign capital flows pull away even faster, which causes the dollar to dive and our asset markets to really take a big hit. So he's really in a tough place right now to see how he navigates this. And there is no right, clear direction at this point in time.
Yeah. The president has long been said one of the best ways to make America great again is to build more things, make more things here in the U.S. Do you think then that these tariffs could create that?
No, absolutely not. Look, I appreciate that we have this weird idea that we need to bring jobs back to the United States, right? This is what he's talking about. We need more manufacturing jobs. The problem is, who's going to work in these jobs? Keep something in mind. We have a full employment economy. The U.S. unemployment rate is 4%. Wage rates here in the United States are significantly higher than within many of our trading partners. Thus, if you try to bring jobs back, even if you could find someone to work in that job, they're going to do so at a significantly higher wage rate, which means, yet again, higher prices. This is not a comfortable situation for the U.S. economy, as the case may be. And of course, it's intensified by the idea that Trump has also announced he wants to throw potential workers out. He wants to stop immigration. He wants to deport undocumented people. Well, how do you bring jobs on and throw workers out at the same time? It obviously is a nonsensical objective.
What do you say about Governor Newsom trying to direct his administration to explore trade relationships and protect California?
Yeah. Yeah, well, I mean, this is called virtue signaling, not anything real. Look, trade policy is 100% within the purview of the federal government. States have no control over this. We don't control our ports. We don't have our own trade policy. So, sure, Newsom wants to present himself as the rational guy in the room, the reasonable guy in the room, but the reality is the state has no actual leverage here.
Okay, so because he was, we were showing or sharing some interviews with the governor where he was saying if California is the 5th largest economy in the world, then maybe California-made products could be excluded from retaliatory tariffs. But you say there's no way that's possible because this is a Fed thing.
It's a Fed thing, and we certainly can't do that. Yeah, I just don't see any more than Texas can control its borders unilaterally. We just don't have those rights.
All right, we down at the bottom corner of the screen, we're showing the Dow Jones Industrial Average, thick red, little bit of green, now back in the red. How do you recommend people watch this?
Well, look. We all know that you're not supposed to try and time the market, right? Mm-hmm. It's the kind of thing where if you play these games on a day-to-day or a week-to-week basis, you're going to lose. The reality is the market is pushed around not just on what's happening within the economy, but rather relative to what the market thinks people think is going to happen relative to the economy. And in that kind of crazy, volatile world, the market is always kind of bouncing around. And if you try to guess what's going to happen, well, ultimately, you're going to end up hurting yourself. The best thing to do is make sure you have a well-diversified portfolio of equities that include both U.S. equities as well as global equities, and ride it out. It's as simple as that. The horse is gone. There's no point in closing the door.
It's easy to say to 25-year-olds, write it out. 60, 75-year-olds, a different story.
Well, you shouldn't be that heavily in equities anyway. Okay. This all goes to the idea that our portfolio should be a function of where we are in our lives.
Great. Dr. Chris Thornberg, thank you so much for your insight this morning. We really appreciate it.
Pleasure to be here.
Great day. We'll be right back.
Hi, I'm Monty Torres with Fox 26 News on YouTube. Thank you for checking out our YouTube channel, where we have loads of great content for you to choose from. And while you're here, why not click on the subscribe button right here? That way you can stay in touch with all the latest breaking news, everything news related within the Central Valley. And thank you for watching.